Hey, everybody, it's Larry Berman here. Well, this is it for a while. First of all, I want to wish everybody a wonderful 2026, happy, healthy, prosperous. It's been quite a year in 2025, a lot of different dynamics. Historically, the last one of the year is a fearless forecast where I look at what we felt about markets a year ago, some of the calls we made, right or wrong, and then what we think for the year ahead. So more on this on Monday's show on BNN. But as we look into the next few weeks, next live YouTube cast will be on January 16th. I'm going to take a little R&R time, doing a golf trip in the Caribbean with my best friend for life, celebrating his 60th birthday, which many of you know I celebrated this summer with a hole-in-one on my birthday. So little golf trip in mind. Here we go. We're not going to Augusta. It is in the Caribbean. We're playing some of the best courses down there. So I'll report back on that when I can. But let's take a look at the chart room and have a look back and then a look forward. A year ago for the S&P 500, basically we're cautious on the year after having two very strong years up. Historically, it's on the rare side that you get three strong years up. And of course, as we got into the first quarter, looked really, really good until it didn't. And tariffs became, policy number one until they weren't. The flip-flop nature of economic policy in the White House, I do believe that President and many of his friends are profiting from the headline volatility of Truth Social. Anyways, we can unpack that another time in terms of ethics. But 3 years now with very strong returns back to back to back, it's extremely unusual that you would get a fourth. And forward-based returns based on the multiple of the market, based on a rolling 3-year window, almost certainly suggest a flat to down year for the S&P. Having said that, economic momentum, one big beautiful bill has some positive economic carry through the first half of the year. There's going to be some accelerated depreciation on taxes. So anybody who was going to spend in the next year or two from a financial control perspective makes sense to bring that forward so you can write it off faster. And so that economic momentum first half of the year should probably keep 2026 in good shape from that perspective. Forward-based earnings is expected to grow in the 13-14% range. And so a lot of positives there. If we get some volatility, the first test is probably that rising 200-day average. Obviously, during the tariff period there, it broke. It actually broke in front of that. Where is the first line of support from a retracement perspective? Around 5,600. So I could see in Q1 that we test the rising 200-day, probably not more than that. If we are going to get a correction, it might come towards the midterm elections, depending on how the polling's going and various different factors that we just can't predict right now. Consensus, if you look forward earnings, 7,400 top down. I could see 7,400 being tested in the first half of the year as well. So, buy the dips, probably first half of the year is where your mind's gotta be. With that dip, probably worst case scenario limited to that rising 200-day. What changes that, of course, is the labor market outlook. Powell had said in his most recent press conference, the Fed believes that the job growth is slow, but actually being overstated. So the U.S. is already losing jobs. To the extent that stimulus can be put into the market or is needed, with stocks at all-time highs, to me is ludicrous. But as Stephen Marin pointed out, in one of his recent commentaries in financial media, he's trying to think about the lagged effect of monetary policy a year or two from now and thinks they need to cut now because it's going to be worse after the midterm elections. So that is probably a good lens to think about, that if we're going to get a much bigger correction, it's probably a latter half of the year or even in 2027. So the notion of the market starting to price in rate hikes in 2027 is ludicrous to me. So there's a lot of mispricing going on now, I believe, and it'll be interesting to see how that really all plays out. If we look at the TSX, monstrous year after a number of years of lagging performance. Don't think it's sustainable. Definitely there's some momentum here, and that probably continues into the first part of the year. If we do get some economic slowing, oil markets are telling us already that that's coming. We're well supplied there, probably continue to be. So I think correction risk on the TSX is first half of the year, not second half of the year. And, energy and specifically financials that have been, really leading here with the dramatic steepening in the yield curve that we've seen. So I think that steepening's over, flattening probably, led by the back end coming in. Going to be tough for the Bank of Canada to keep cutting rates here. Maybe one more rate cut in Canada. So I'm less optimistic on the TSX this year. Last year, far more positive in terms of, looking at where value was in the world. So we were overweight places outside of the U.S. last year. Proved to be the right call. Canada, international markets did a little bit better. Again, where's support? Think of that rising 200-day average for now to buy dips. But I would say almost certainly at some point in 2026 that we're going to come back into this retracement area and test the breakout in 2025. When you think about the Canadian dollar, structurally weaker in Canada. I don't see a fix for that anytime soon. Relative rates and all. There is a call at some point for the Canadian dollar to get back to maybe 75 cents, 133.33. Probably not much more than that, maybe a little bit more on the charts here. But really what's needed to happen in that case is for the oil markets that, were post Ukraine, Russia, popping over 100, but really consolidating and falling. Forget this anomaly. We're not going back to negative interest rate or negative oil prices. This is inverted oil price, by the way, with negative $40 here and 120 here. So there should be very, very strong support in the 40-50 range for oil, and that would be worst case scenario. Basis West Texas, Strategic Petroleum Reserve, going to get restocked. That, in a big way, will come at some point, second half of the year. Trump is very political here. He wants to keep control of Congress. Every incentive to keep oil prices weaker first half of the year and start to bolster them later in the year should prices get too weak. So there's a balancing act there, but that natural buyer should limit oil prices from getting too much weaker here. But U.S. looks in the next year to be capped in terms of their production ability, and that oil independence notion in the U.S. is mostly in the rearview mirror and of the past decade, not the decade ahead. I wouldn't expect the Canadian dollar to bleed past the worst levels we've seen during the tariffs. So there's several spikes in the last decade into the 145 area, and I think we've established that it's unlikely to get worse than that at this point. Long bond in the U.S. Long bond in Canada, but long bond in the U.S. Fiscal outlook is not going to improve at all, ever again, unless they make structural reform changes to entitlements. And I don't think there's ever going to be a political will to do that. So, we're not going to see TLT and long yields get to these levels again. Even in the next recession, I would be shocked if the long bond could get below 3%, again, given the supply of bonds that would be needed. So, you're really looking at a range in the long end of 5% to maybe 4% in 2026. And so basis TLT, you would call that a little over 100 to probably 84, 85 on TLT. And that range, I think, is pretty solid trading range. We blow that up a little bit. You can look at basically been there the last 2 years, and I think we stay contained in that range. And finally, gold, in log terms, you just got to say, wow. Gold will correct. Don't know when. When it does, it's likely to be violent. What we've seen historically is these massive speculative run-ups, and when that speculative fever dries up, we get a pretty major correction. I would look for that to be somewhere in the nature of 50%. We could go to 5,000 first. I don't know. The momentum is certainly there. Central bank buying is still supportive, while jewelry demand is falling off. Again, fiscal outlook, inflation considerations, etc. Probably higher before lower, but at some point, a pretty monstrous correction. There's a lot of speculative money that's come in to the precious metals. So I would be very, very concerned if, for example, let's blow this up again, we start to violate the trend of higher highs and higher lows. So right now, end of the year, we take out, say, 38.50, that would be a really big problem for spot gold any point during 2026. So that's where your stop should be at this point, and look for it to probably continue to grind higher and be a lot less robust in its upside potential than what we saw in 2025. Anyways, that's it, folks. Happy New Year. Have a great holiday time with your family. I'm going to enjoy some vacation time. I will be back here January 16th, and I'll be back on BNN the Monday following that. Have a great one, everyone.